Hello, and thank you for joining us today for our webinar, New Year, New Budget, Financial Resolutions for 2025. My name is Angela Bachman, and I will be today's moderator. We have an exciting agenda planned for you today on the topic of budgeting techniques, strategies, tips for saving, and ways to stay motivated throughout the year. With that, let's get started. I'm going to turn things over to Todd Moore, Director of Education with Trinity Debt Management, to introduce himself and take us through today's presentation.
Well, thank you so much. It's great to be with everyone today, and I look forward to sharing some information with you today to kick you off and start you off this year in a positive direction as we try to move our finances forward in 2025. But first, let me just say that it's a pleasure to be back with the credit union today. Always like to start my presentations off with a few stats. I hope that you can appreciate that if you've joined us in the past through our webinars. But a couple things as we kind of set the tone for the presentation today. When we look out at some of the recent data that was collected, where are folks at? How are they feeling about finances as they move into 2025? One of the things that we start to see is that there's still a great deal of stress and some concern within the economy as we begin this new year. You can see a range of items here. Folks are still feeling some stress about the ability to keep up with their monthly expenses. Paying down debt, that will be a repeated theme that you hear throughout the presentation. And then also looking at retirement savings in itself. We think about financial resolutions for the new year. Certainly, these are all areas where we can use some improvement. And the goal today is to really think about how we can use a budget to kind of take those priorities and set them into motion. So I'll walk you through some areas and point out how I believe that we can get started doing that. The other thing here that we're looking at is the couple of items on the bank rate survey. One of the things I found interesting on these statistics here was that folks are feeling that they're just not making any progress. They're uncomfortable with their emergency level of savings. They feel left behind in the retirement savings, and they just otherwise would feel that if they could get some of these things together, how much more successful they would be in the coming year. And the Motley Fool Money site, if you haven't visited that, lots of great information that's listed on that site as well. You see that folks are excited about creating a financial resolution. 69% of respondents in that survey excited about making some type of resolution. And then others that feel that, how will this work out? Will inflation continue in 2025? What will be the outcome of that this coming year? And folks are just figuring out, how do I set this plan in motion? Paying off debt being one of the big goals that comes out of that for 2025. So you can see, just looking at those numbers in itself, that we remain kind of optimistic about the new year, but concerned about where things are at as we move forward. So when we look at financial resolutions for the new year, I thought we would just narrow things to a couple of categories. First things first is just looking at our financial position and budgeting, credit and debt, investments, retirement, and home ownership. These are 6 of those big financial resolutions that I think would have a tremendous impact in the coming year. And if you're thinking, if you're on the call, hopefully these will be broad enough to capture some of your interests as well. But the goal today would be to look at that centerpiece where we look at budgeting and how to align these larger goals within these various categories. So one of the things that I would like to encourage you to do is figure out whether or not you're asking the right questions. Oftentimes we need a starting point. And when we're looking at setting priorities for the year, sometimes we're just struggling, which budget do we pick? Which direction do we go into? That's one of the things I'm hoping to share with you today, is to try to figure out which one of these approaches might work best for you. There's a number of approaches that you can take, but I think in the next couple slides, you'll start to see that depending on which direction you go, whether you're someone new to budgeting or someone that needs a little more direction, I think one of these 2 budgets should work really well for you. The first one I want to look at is the 50-30-20. Here, what we're looking at is 50% of your expenses that are in this required expense category. So if you take your income and your expenses and start to try to discern how you're going to spend that cash, one thing we're looking at is 50% is going into just looking at required expenses. And then this creates an immediate savings goal. So if you take your overall income, 20% of that goes into an immediate savings. And then we go into discretionary expenses. Then we go into discretionary expenses to where this is where you have some flexibility in how you spend your funds. So this is really intended to be one of those big picture budgets. A lot of flexibility that's built into this particular budget. If you're new to budgeting, I would say start here. You know, you think about those larger priorities that we laid out in the prior screen. If you're really anxious to get started on a financial plan and trying to figure out where you would go, 50-30-20 is a great place to start. The second part of that would be looking at what we call the money flow budget. So this is one that you can really align with your account at the credit union itself. So the goal here is to be able to set it and forget it. Part of that means that you're looking at your reoccurring expenses and trying to figure out how do you structure a budget so that you can have bill pay set up or maybe automatic deduction. You're trying to use those tools to kind of set this, kind of create a money flow that allows for expenses to become routine. You have money transferred over into separate accounts. So you can set and pay expenses right from your checking or savings account, so long as you set this budget up to do that work. The difference here is that you really need to have built some budgeting skills before you kind of get started. So a couple of things to consider before you move into this particular approach. One would be that if you have reoccurring expenses and right now you're carrying some debts, you want to be very careful that you're not going to overdraft your account, things like that. So you would want to certainly set up a budget that minimizes debts first before you do any type of money flow approach, because if money is starting to be transferred out of that account, you start having overdraft fees, the whole process is really out of alignment at that point. So these two budgets, though, get you started. 50-30-20 is always that approach you would take. It's kind of big picture and loose, gets you started, and it sets three fundamental categories: required expenses, savings, and then discretionary expenses, all aligned within that particular approach. And then money flow would allow you to establish those reoccurring expenses and then use automation to kind of solve those debt problems that maybe you're struggling with, or to create savings goals. So both approaches are effective, and I can help you as well through Trinity, and we can also work together with the credit union to make sure that we can set one of these approaches up for you that would best work for your situation. But certainly here first, if we have some debts that we need to pay down, we would want to do that before we move into the money flow approach. One of the other things is that we're going to start looking at the ability to create emergency savings. So again, automation becomes a very important part of this. Now, what I'm going to encourage you to do is take a look here in this middle section. So when we're working through, oftentimes, if we look back at the last couple years, inflation and could be job losses, but particularly inflation has really been very challenging for most of us as we try to create any type of emergency savings. So what we're trying to do here is figure out how do we quantify this. We need some real numbers. So what I've done here is just, let's say that you're needing a starting point, your savings is really low. I've got it worked out here to, out of our budget, our goal is $83 a month. We just want to get $1,000 in our savings. So we're going to start very small and incremental amounts over the next year to try to create some modest savings, rebuilding emergency savings fund. Or you might even want to look at this a different way, where you'd say, at this point, I'm trying to increase my overall savings. Again, you could supplement your savings in some way by taking this approach. bottom line is we need a starting point, and we need some type of timeline to accomplish this work. So I want you to think about that as you put together your plan this year. Your budget becomes that guide. So you want to draw from those funds, create a targeted date. When do you need this money? When do you plan to have and rebuild this emergency savings fund? How much will it take, over the next 6 months, year to kind of do this work? Most of us, we need some incremental approach to do it. But figure out how much you're going to set aside each month. So take the stress out of this by just kind of breaking pieces down into incremental amounts. I've given you a starting point here, but you can always look at your numbers and see, how much can you afford? 20% of funds that we talked about in that first budget, let's assume that you have $4,000 a month. $800 in savings is a pretty big goal. So a lot of folks may not be able to put $200 a week into some type of savings. Narrow that down, okay? And so at minimum, I want to encourage you to at least go down this path where we kind of build some savings over the next year and transfer those funds over through a different account with the credit union. Start building your emergency savings in 2025. One of the things too is to look out beyond just what you're contributing to a fund. Other ways to build your emergency savings fund would be to increase contributions. Now, go back to some of those statistics that we talked about early on. Folks struggling with a retirement goal, or maybe they have not contributed fully to their 401k plan. You'll hear me talk about that again later. I've seen this, I always try to stress this in the presentation, because when I'm working with folks in the community, financial planners and others, businesses, we see underutilization in 401k or IRA. So if you want to think about that as savings, what you're contributing to these plans certainly is part of your long-term savings goals. Also, continuing to do just automatic deductions. I'm a big fan of doing this because it's incredibly easy and it's effective. So if you do payroll deduction, or even working with the credit union to just start making those minimal $83 a month contribution towards your savings goal, break that down, $20 a week. This really adds up over time. So the goal is, though, when you're looking at emergency savings, that you're taking multiple ways of looking at this problem. So what we do through automatic payroll, or you transferring funds through transactions, or just having a goal that you increase your 401k or other retirement goal over the next year. Tracking spending. Talk a lot about this particular approach. The key here is that you're keeping, oftentimes we think about this in terms of just cash expenses. So if you think about you putting together a budget, within that budget, you have your income, your expenses, kind of categorizing expenses, looking for that bottom line. How much do you have left at the end of the month? Trying to figure out how you prioritize the funds. When you're tracking expenses, this is funds that you're looking at outside of just what may be captured in your overall monthly budget. So when you're tracking, what you're trying to do is we're trying to shift behavior. We're trying to figure out how, at that point, can you take some incremental approach to track cash expenses that are not captured in the document itself. So the GE money management tool is a great way to do that, and you can do that through online banking or your mobile app. And then the other way is, for folks who are not using online tools, if you want to simplify this, whether you do a spreadsheet method, pen and paper, and a small notebook, or just looking at your transaction history, you've got to keep a watch on your money. Okay, and what that means is you're looking at these patterns over time and how you're spending funds. So if you think about what you might spend over the next month, I'm going to encourage you to track over the next 30 days. What you're looking for is repeated patterns. Where are you most likely to spend money? What does this picture tell you about yourself? And what we're trying to capture is some small amount of money, even $50 to $100 through this exercise, to apply it to debt repayment. I'm going to show you here in a few minutes how between $50 and $100 can make a tremendous effort in reducing overall expenses. So tracking your expenses, and tracking your spending is going to be one of the goals that I'm going to nudge you forward in 2025 and ask you to use, as I always do, to use the money management tool and to continue to track and try to shift behavior this coming year. So next we're going to shift gears and look at credit and debt. Most of us have a larger financial goal. I'm sure that many of us will be looking at some larger financial goal in 2025. One of the big parts here would be looking at just overall credit score. Here I've got it broken down into various categories for you, where you can see the various credit scoring categories and the percentage value aligned there. The real question is, where are you at in this model now? You know, why is your score X, whatever it might be? Let's assume that right now it's kind of stagnant, it's not moving, and you have a major purchase that you have planned. So we have to figure out how to use this and how to pay off debts and improve our access to credit here in this next year. So first, it really begins with you kind of identifying what your overall credit goals are this year. So many of us will have, you know, perhaps we want a new car, might even be thinking about home ownership, might want some type of consolidation loan, personal line of credit, all sorts of products and services that you can obtain through the credit union. So we want to get a baseline of where we're at right now. So the first thing for us to do is certainly to pull a credit report for you, get some numbers in front of us to figure out how we align some type of strategy to raise your credit score. The way we like to work together with the credit union, I certainly can pull a credit report for you. I can do that work. It truly is free as a member of the credit union. So that will give me some baseline score as we get started. And then we can look at your budget. Using those two items, we start to create a plan. We start to figure out how we can go about debt reduction and raise your score towards the larger goal that you've established, whether it's a car loan, home loan, or whatever particular goal that you're aiming to reach. So if you need help this year, and it's part of one of your financial resolutions for the year, certainly reach out to us. We want to help you raise your score and help you acquire the products and services that you need. So we're going to be looking at a couple of categories here as we think about raising our overall capacity or improving our score. First thing there is keeping your total debt manageable. So right now, as you noticed in some of those early slides, looking at just goals for the year and some of the data, paying down debt remains consistent across the numbers. It's consistent, and I know we're seeing that here at the office, and I'm sure many folks, maybe even on the call, are feeling that need to kind of reduce debts. We'll be talking about ways to accelerate loan repayment, and then some methods to pay your credit cards down. Thought I would share this with you. Lending Tree, after Christmas, they were looking at consumers that have holiday debt. I'm one of them. Not significant, but I still, like most of the numbers, carry a little debt at this point after the holiday. But you can see on average, folks spent, you know, almost $1,200, and then folks used credit cards to make those purchases. One of the other big ones that we've seen here recently, and I think we've talked about this briefly in some prior presentations, the buy now, pay later scenario, which has really been popular with borrowers in the last couple of years, but it's really ballooned. More and more access to these types of loans online. But when we're looking at holiday debt, certainly we want to be able to look at ways to pay that debt down in the coming year. I think statistically, folks that accumulate holiday debt at the beginning of the year, they carry it well over into the next year. So one of the things we'll encourage you to do is to work on reducing your outstanding debts. I'm going to start with just trying to figure out, how do I shift what we call the credit debt ratio, okay? So again, looking at our budget is always a starting point to figure out how much cash do we have available to tie it to this financial goal. The idea here is, if we can, when we think about credit debt ratio for FICO scoring purposes, you can see here 30%. Oftentimes I will call it the 30% rule. we're looking to bring those balances down. Anything that's beyond 30%, what we find through the rule is that it starts to lower our credit score. So what we're trying to do is figure out, how do I shave off those balances, reduce our debts, to make certain that I can get somewhere to 50 to 30% and then just pay off. Okay. So credit cards and unsecured debts are the biggest part of this particular approach when we think about credit debt ratio. Student loans are not factored into that. They're not factored into the model because we can't discharge them through bankruptcy. But the key here is, when we're thinking about this, is trying to figure out a method to reduce those card balances to raise your score. And we'll be talking more about that in the coming slides. So I thought I would throw a little bit of math at you here. We won't get too far into this, but it's one of the things I looked at here was, when you have a card that is, let's say you're carrying $2,700 of $5,000. And through this approach, one of the things we're trying to do is just figure out, how do we bring this account, this number down. So what I've tried to do is, if you continue to make a payment at $81 every single month, takes you over 5 years. This is what we might refer to as just that minimum payment debt trap. We're just not making any progress. So for most of us, I think $50 to $100 is a pretty modest goal. I think whether you're tracking your expenses or just using some budgeting techniques, there's got to be $50 or $100 somewhere within your budget. So taking that same approach, adding $50 and now making that payment $131, okay, just taking the monthly minimum, adding 50, what we find is we shave off over $1,000 in interest, and then we're able to pay that card down in probably half the time. I think it gets us down to less than 2 years. So when we're looking at this approach, this is the power of accelerating loan repayment, okay? I'll share with you some tools later where you can use a credit card repayment calculator to kind of put these pieces together. But when you're thinking about doing this, again, this is where we want a timeline, we want a dollar amount, we want to be able to quantify or say what that's going to look like. So how much money will it take for me to accomplish these larger goals? So in this case, all we're doing is we're just accelerating loan payment with $50, the power of $50. And here's the math. I mean, it's in front of us. It tells us, what that payoff timeline is going to be. It tells us the amount of interest that we've saved, and we've cut in half the time just to pay off that particular card. Now let's assume that we've got multiple cards that we're trying to pay off. Again, debt reduction being one of our goals this year. And I've listed three scenarios here: $700, $2,500, and $4,750. So we're carrying some various balances. The goal here, even with the different interest rates, our minimum payment's $287. So this takes us over 40 months just to pay this off. We're going to add $100 to that payment. Okay, so I'm going from $287 to $387. But you can see here, we're going to pay off in 27 months, and we're going to save thousands of dollars in interest. That's the power, again, of just making a $50 to $100 minimum payment, or increasing your minimum payment by $50 to $100. And you can get pretty crazy about this. I've gone in and played with all sorts of numbers. It's kind of fun to see how this math works out. But the credit card repayment calculator is a great tool to use. It will give us the interest reduction, and it really will show you some fantastic ways to really just use small amounts to increase monthly minimum payments and cut these timelines down and save us money long term. Now, I've noted here, we haven't done anything to reduce interest rates. We haven't entered into any kind of plans. These are things that you're just simply doing through budgeting and the power of increasing or accelerating debt repayment. Another approach to this would be looking at a debt consolidation loan through the credit union. So the scenario here is we've got about $24,000. Our monthly minimum payment is $630 at this point. Got a pretty high interest rate at 18.9. So is this going to take us some time at this rate in dollar amount to pay it off? We're looking at 59 months. So what are our options here? So considering if your credit score is high enough to get into this particular approach, you're able to enter into a slightly lower monthly payment. And through the consolidation loan itself, you're going to find that you're going to reduce the amount of repayment down. Again, same concept, you're just accelerating the loan repayment through this approach. Here you're getting a lower interest rate, and we're saving ourselves that larger, the interest that would accumulate over a larger period of time. So if you have questions about any of these particular approaches, or if you need a loan and you're looking to pay off, again, we can pull a credit report, we can work together with the credit union to try to find this strategy that will work for you. And for many of us, the consolidation loan will work very well and help us reduce our debts this year. So now I'm going to kind of take us a little further into debt repayment strategies. I'm going to kind of position you around 3 strategies. These are time-tested strategies: credit utilization, interest rate, and the rollover approach. One of the things here, I thought I would show a couple other quick facts, things that I thought was interesting. You know, right now, the country is carrying significant amount of credit card debt. I think we're over $1 trillion in credit card debt nationally that we're carrying. Half the folks that continue to be surveyed carrying some debts. Interest rates, you know, 20% plus interest rates being the norm at this point. So certainly know that you need an approach to how to solve that debt problem. So credit utilization is one method that you can use this year. And we've talked a little about this as well in some of our prior credit scoring presentations. Want to reiterate some of those points now. Again, tying it back to budgeting, trying to figure out how you use these 2 methods and align them for debt repayment. Under credit utilization, what we're looking at is you're going to rank order unsecured debts, mostly credit card debts, from lowest to highest amounts. The goal here is that we're, again, shifting credit debt ratio. So we're looking at trying to find a way to reduce those debts, bring them down somewhere around 30%. That's always the goal. So if you use that debt repayment calculator, calculator.net has this as well. There's some other calculators out there. Some of the financial institutions will have them, maybe even through your card holder itself, depending on what features are built in. Calculator.net is where I've used many of these financial calculators. So long as you can put an interest rate in and the dollar amount, it's going to calculate that for you. But you start to play around with some of the math. Again, if you want to shave those account balances down, you can figure out through that calculator how to do this and shave it down to 30%. We're taking the edges off, okay? So we can't pay everything up front, but we're going to reduce and rank order and just try, our goal is 30%, somewhere to massage that thing down to 30%. It takes some work, but it is an efficient method. And what we find out is that I've, in practice, worked with so many folks to do this method. I just find that in personal finance, you need some energy, and you have to find a way. We're looking for efficiency, how to use the funds that we have to do the work. This is a great method. Bringing some of those debts down, kind of shaving off some of the balances. The goal is 30%, and then to pay off under credit utilization. Interest rate takes us into a different scenario where we're looking at just looking at the interest rates itself. So oftentimes folks will say, okay, you know, I really want to focus on the card that has the highest interest rate. And under this approach, interest rate method, what we do is the highest interest rate is we work on that highest interest rate first, and then we start to rank order cards as we go down. The goal here is that, you know, if you have a card that say, you know, 27% interest rate and you're making monthly minimums, we're going to increase those monthly minimum payments, as I talked about before, maybe by $100. So let's just assume now we're making that $387 payment. We're paying on that with that highest interest rate. That becomes a set part of our budget. And then if you have multiple cards, that's where we have to kind of figure out what that payment amount is going to look like across multiple cards to try to set in, you know, in practice, highest interest rates kind of rank ordered. What I found through this method, though, is that as you start this, it's a slower, if you do this work, what you're typically going to find is that if you're focusing only on that highest interest rate card, it starts to be a very slow way to reduce the debt itself, and slow to show the credit score or credit score improvement. So for a lot of folks, it can just be fatiguing. Again, working with so many folks in the community, and counseling over these many years that I've been doing this, once you become fatigued in this work, it becomes very difficult. You know, we want to capture your interest and keep you interested in doing the work. There are some good mathematical reasons and financial reasons to focus on the highest interest rates cards. But if you're looking to see a credit score improvement, this particular, and we're not putting an adequate amount of money towards this particular approach, it can be a very slow method. I can take a lot of that guesswork out of it for you. Contact me. I can work up a plan for you, and we can differentiate which one of these plans would work best. But this is the interest rate approach. And then lastly, the rollover method. So here we're rank ordering from lowest to highest outstanding debts. So let's assume you've got a card that's, you know, $1,000. What we're trying to do is we're going to pay it completely off, as opposed to that 30% rule where we're shaving some of that debt off the edges, bringing it down to 30%. Here I'm going to pay entirely off at the lowest, regardless of interest rate. Whatever card just has the lowest amount, I'm going to pay completely off. Then I'm going to roll forward all that additional savings that I have is going to be rolled forward to the increase of my monthly minimum payment on card 2. I'm going to pay it down in 3 and 4. So this is a very effective method. It shows, you'll see that debt reduction start to increase the overall credit score. I've found it to be efficient. And the other thing too is it's motivational. That's one of the key things. Again, I cannot emphasize that enough. As you're doing the work, you certainly want to see your efforts reflected in your credit score. So those are three areas, just thinking about strategies to look at for debt reduction. Any questions on that, put them in the comments, or just give me a call. Be happy to walk you through those areas. We're going to go now to another portion of this financial plan, other parts that you may find as a financial resolution this year. If you haven't sat down and talked with someone about your overall investment mix, maybe this is the time to kind of start thinking that through. You know, how are your assets allocated? Do you want to take more risks? Do you want to kind of choose a few things? Do you feel that the market's changed enough? Do you need help in making that decision? These types of things require some specialization. They require you working with professionals that really are engaged in this work. It's part of their career and their work that they do every day. Take the guesswork out of that and work, you know, with someone. If you need a starting point, certainly we would put you in contact with the partners at the credit union to help you with this work. But, you know, having a second look as we start to kind of just start this year off and figure out where we want to go. Maybe there's areas that you just underinvested in that you want to change this coming year. The goal here is to have you take a second look at where you're at. So as you're rebalancing your budget, trying to figure out which one of these goals, where should you start? This is a great place to start to think about some of your investment goals for the year. I've also included here a 529 education plan. This is a great way if you're trying to save for college. There's a lot of benefits in the 529 approach. Tax deferred. It can be used in multiple ways. I would encourage you to look into that if you have children, or if you're looking at trying to supplement some type of college fund and you're planning out and wanting to do this, even if you're kind of late to this process where you want to start, you know, with someone that would graduate in the next 5 to 7 years. It doesn't have to be from the very beginning, you know, kindergarten. Earlier the better, but let's be realistic. Sometimes we just need a starting point. This is still a wonderful way to start. And if you're looking out, this even applies to even graduate education. So lots of flexibility, but this can be a great way to think about a longer term investment in education if you haven't looked at the 529 approach. So I thought I would share that with you. And again, the goal here is just to have you take a second look and speak with professionals through the credit union that can help you optimize your investments and optimize your approach this year. The other thing too is preparing for your insurance needs. Just looking at your overall risk. There's always risk. And if you haven't maybe purchased some of the insurance that you need, I want to encourage you to take a part of that and build that into your plan is really what I'm saying. So if you're a new family and you haven't had term insurance, or maybe you haven't invested enough in insurance, I'm going to encourage you to reach out and to take time to purchase some plans that will protect you and your family should something happen to you. Get your records together. I can always do a better job of that myself. I always tell my wife that I know where everything's at. That's not always the case. But this again is really just trying to take another look at how we approach at budgeting and align it to a financial plan that just sets us in motion to be strong in 2025. That's really what I'm encouraging you to do. And the more that we can take risk out of this plan, the better. Insurance plays a very important role in reducing risk. So whether it's long-term disability or you looking into purchasing some type of life insurance plan if you haven't, or maybe increasing the plan that you currently have, I'm going to encourage you to do that and work with the credit union to make certain that we find adequate insurance to make sure that your beneficiaries and your family is protected. Retirement we've hit on a little bit. I will just say this one last time about underinvesting in employer-sponsored plans. Listed several different plans here. Again, one of the areas that I consistently see that's just underinvested, an area where I feel that folks just underinvest is in their employer-sponsored plan. So, there's plans that offer 3, there's plans that offer up to 7. There's some incredible plans that I've seen working with folks in the community and with different businesses and nonprofits, even governmental organizations. The goal here is that if because of inflation you've cut back over the last couple of years and you cut back on what you were contributing, now's the time to kind of think that through. If there are ways that you can minimize your debts this year, even if you can't fully take advantage of the employer match, reducing those debts this year by budgeting, having that as one of your financial resolutions that you're committed to and that you can reach this year, increasing that employer-sponsored plan, making sure that you're getting the full value, it's a tremendous contribution. And for those small increments of change that you would make, it has long-term consequences financially. So, said this many times, I'll say it again, make certain you're taking advantage of that max and that you're fully contributing, get the full benefit of the employer-based plan. And I know some folks, they're looking at IRAs as well. Want to encourage you to speak with folks at the credit union if you need someone to speak with you a little bit in detail about establishing an IRA or just contributing to an IRA, getting that started. In addition to an employer-sponsored plan, this would be a wonderful way to have another bucket of funds that builds your retirement. So again, lots of room for improvement here for us all. But I do encourage you, I consistently see that folks do not fully contribute to the employer-sponsored plan. So I'm just going to nudge you forward one more time and say, if you're not doing that, please do. It has tremendous consequences for your finances long-term. And then lastly, we're going to look at home ownership because despite where the market's been in the last few years, I'm going to be optimistic now and say that I'm looking for the markets to hopefully we've gone through enough of this period of inflation where we've kind of worked our way through this. There's some glimmer of light at the end of the tunnel, I guess, but we still got a long way to go. But if you're thinking about home ownership or you're financing some type of home renovation in the coming year, now's the time to really, it's a new year, it's a new budget, we've got new financial goals, want to really step back and in addition to your credit score, start thinking about really what can I afford? Home ownership is one of those things, it's so exciting to think about purchasing your own home. It's always a challenge to think about how you establish the down payment and all the other parts that come in with financing home ownership. You know, the 26-36 rule here that I've listed, sometimes this will be referred to as front end and back ratio. What we're looking at is your gross monthly, 28%. This would be the affordability part, the front end ratio, looking at how much you can afford. You know, you look at your income and expenses, what's your gross monthly income times 28%. That kind of gives us a ballpark figure on affordability. And then looking at your expenses times 36% gives us some indication of where we're at in this. Again, looking at affordability, what's our mortgage costs? The goal here, though, is that we put this plan into action. Okay, so if you're a new first-time home buyer and you need some assistance here, looking at ways to create savings or affordability, let us help you create a budget, reduce debts, figure out some of these housing ratios, and see if there's a way that we can work with a credit union to start you down this journey of becoming a homeowner. Others may be wanting to renovate their kitchen. I could certainly use that help myself. Or just make some housing renovations, windows and all sorts of things. I mean, we just had some tremendous cold weather. My house was put to the test. Like many folks on the call, I certainly could use some help there as well. But this gets us started thinking about either purchasing a home or making those needed renovations that maybe we just put off the last couple of years. Maybe now's the time to do that. So if you need some help with trying to create some type of savings for down payment, you know, put some numbers together here for you. Typically, you're looking at, you know, 3%. We've got closing costs that are part of housing finance. There's a lot of details that go into just obtaining a home loan. But the goal is we need some way to create some type of savings. There's various ways that we can help you do that. I'm going to encourage you again, just reach out to the credit union, okay? All of these products and services that we're talking about today, if we can get a budget in place that looks at our income and expenses, structured around one of those budgeting methods, 50, 30, 20, the automated plan, if we get something started this year, then we can align it to these particular goals. And that's really the purpose of our call today, is simplifying that process for you. If you need help with a down payment, you know, and creating that savings and saving strategy to get there, please give us a call. That's why we want to help you. A mortgage lender will help you. And there's multiple ways that I can work with your mortgage lender to help you along the way as well. Financing and renovation. If you're looking for home equity line or personal line, you just want to speak with someone about, you know, making that needed renovation, windows, kitchen, those sorts of things. Right now is a great time for us to have that conversation. Just give us a call so that we can help you find the financing option that will work best with your budget and where you're at right now with your credit score. If you need help, just give us a call. Okay, that's what we want to do. The better the score, the better the interest rates and the better affordability for you. So if you feel right now that your score is maybe a little lacking and you need to do some debt reduction, maybe we need to wait. You know, maybe we need to wait 6 months until we can take a second approach at your credit capacity. Let's do some work there first. But the goal is, if these things have gone unrealized over the last couple of years and just were things that you just couldn't afford, this is a great way to make an investment in your home or to actually finally get to the point that you can become a first-time home buyer. We're certainly here and eager to help you accomplish both of those goals. So one last thing that I want to encourage you to do, and this is part of our webinar series itself, is I want to encourage you. I think that General Electric Credit Union does a fantastic job of bringing speakers and webinar series to you. The goal is really to improve your financial knowledge and skills. You know, here we are starting off in 2025. Can't believe that we're already towards the end of January. But I want to just encourage you. You know, it's one of the things that I want you to invest your time in over the next year, is just to continue to improve your knowledge and skills. I need to improve mine as well. There's always something new to learn in the area of personal finance. It's an incredibly interesting area to study. But you know, get involved in the webinar series as you're doing today. We'll talk to you about additional webinars and workshops that you can take advantage of. But I'm going to encourage you to, read articles and books and continue to keep up. Attend the webinar series. There's all sorts of online tools that are out there. Some of you may have seen Khan Academy or Coursera and all sorts of platforms, but we want to find quality platforms. If you don't have the time to go out and research all these various things on your own, a quick way to do this is just become part of the GECU webinar series. So there's a whole range of topics, and I think the folks do a wonderful job at the credit union to deliver timely topics to you. So again, I would just ask that you continue to keep part of the webinar series and continue to learn, grow your capacity so you can make informed decisions and just make better financial choices this coming year. So that's it. That's where we're at right now. I want to again wish everyone a happy new year. Apologize if we've had a few glitches with our camera. That's something new for the new year that I need to work into our plan moving forward. Thank you for your patience as we get our camera set up. But happy new year to everyone. It's always a pleasure to work with you. Try to give you a lot of good information, get the wheels turning up here, and I wish all of you the best this year. Please reach out, let me know what I can do to help you with a budget, align your financial goals, and most importantly, put your financial resolutions into a plan that moves you forward this year. So I'll close there and take any questions that we have.
Thanks so much, Todd. We'll now open things up for the Q&A portion with the time we have remaining. I do see a few questions that have come in, so I'll go ahead and get started. If I have a credit card that has been open since 2013 with a large credit limit, but I don't use the card anymore, would it hurt my credit score if I closed it? I hope to hold off, but may need a car loan in the next few months or a year.
Yeah, this is a great question. So the quick answer is yes, it will hurt you. So when you look at your card itself, it's active, it's in good standing. You've had it since 2013. I believe you said it was paid off. So this becomes part of your overall. It's a function of your credit score at this point. So it's included in your credit score. When you pull that out of your credit score, if you have other debts that you're carrying, you're going to shift your credit debt ratio. Okay, so there's two things that are going to happen. One, you violated the FICO rule that says any account that's active and open longer than 7 years, just closing that account in itself is going to lower your score. That's one. Secondly, you're going to shift the credit debt ratio. So pulling that line of credit out will lower your score. All that's taking place right at the time when you're trying to acquire a car loan. So the short answer here would be we want to maintain that account, leave it open, keep it in good standing, continue to make some minor usage of that account through time, but you don't want to close it because it will have an impact on your overall score, and we don't want to do anything that would reflect negatively in our score right before we make a larger purchase such as a car. So don't close the card.
All right, thanks, Todd. A few more here. What is the best way to structure a budget when I'm making varying amounts each month through inconsistent work?
Yeah, this is the most difficult approach. I mean, I've seen folks that were college professors that get paid once a month, which is an incredible challenge, or maybe there's seasonal employment, maybe there's even every other month. Each one of these come with their own particular challenges. So first thing that I would encourage you to do is, this is where I started off by saying, are you asking the right question about budgeting? And this is a great way to kind of emphasize that point. So among all the things you hear about budgeting, we need a starting point. So sometimes one approach may sound really interesting, like the automated approach. But we know that since you have some variation in your account, that's not a tool that would be good for you. You're more likely to fail under that approach than be successful. So what I would suggest to you is let's just simplify things. So what we would do is just look at income and expenses through the 50-30-20. Now, it may not line up exactly to those ratios, but one, we would have the big picture covered. Our income would be going, at least half our income is going into our required expenses. We then create, under that savings goal, I would say that goal becomes that we start to create a fund where you pull some money into this fund through time, start to build that fund so that when your income starts to vary, we pull from that separate account to supplement or fill that shortcoming within our budget. So, if we think about where we're at right now in January, maybe I had a really good month. Next month may not be so strong. Well, I pull money from that account that I've been building over the last, 4 or 6 months. Now I can supplement the funds that I just don't have because of my varying income. So 2 things here on this question: create a very simple budget, perhaps a 50-30-20. And then secondly, establish a savings account where we start to build a fund, call it emergency savings perhaps, but it's just a fund that we use to kind of close that gap when things get tight. If you need some additional help on that, just reach out to me. Here's my contact information. And I can always, work with the credit union to help establish that for you as well. But using those 2 tools, you can really, you can solve that larger problem.
All right. And how do I account for investments when creating a budget?
Yeah, well, first thing, it's important, I think, to kind of figure out what your investment goal is. Okay, so investments can be a broad category here. So, like I've said, I've tried to take kind of a broad approach, assuming that a lot of us are in different places. So, first thing again, I would say one of the goals for you or for all of us is that the more that we can reduce our outstanding debts, that's every dollar that we have going into paying off debts is a dollar that we don't have aligned to or toward our investment goals. So first thing, start to pay off any outstanding debt that you have, starting with credit card debts, any unsecured debts, bring those down and get those paid down as much as possible. And then secondly, you have to answer that question. What is it that you're really aiming to? What is your investment goal? So that's why I've started with the employer sponsored plan. Let's assume that right now you're only contributing 2%. I would say let's get to 3%. So within your budget, we want to do some increases there to get to 3%. If your employer goes to 7%, we want to figure out how to get as much as possible into that employer match as possible. Now, outside of that narrow category, this is where you've got some options. If you're already someone who's budgeting well, paid off your debts, you might look at an IRA, or you might look at 529, or you might look at, working with a financial advisor to figure out a better tool that would work for your situation. So not knowing where exactly you're at, just simplify this process. Always start with that employer match. Speak with a financial advisor about, any of those other steps that I mentioned, whether it's an IRA or a 529. But the goal really has to be defined by you and where you want your investment goals to be long term.
Okay, great. Well, looks like we are coming up on our time. So if you have any further questions, please go ahead and submit them now and we'll get through as many as we can.
Mm-hmm.
All right. I do have one final question so far. It looks like we have a little bit of time left. What is the best way to maintain and update my budget?
Yeah, budgets they're never going to be entirely stagnant. Okay, so there will be some variation as things change in your life. One of the challenges is there's always risk, as we talked about. So to maintain that budget, again, I would say let's have a starting point. We want to create and establish a working budget. We want to put that budget into practice. If you're someone right now that is kind of trying to take that next step, I would say rather than just looking at kind of that broad picture, for you, maybe the step forward in 2025 might be moving towards something like the automated approach. So you may have enough reoccurring expenses at this point, having paid off outstanding debts, that you might want to take an approach where you look at an automated approach where you are now as opposed to paying off debts, now what you're trying to do is it's shifted to a new point, a new financial goal where maybe you're looking at 529 or some type of investment, or establishing more into the retirement goal itself. So really, as things change, what you have to do is you're looking, one, at the broad financial picture, okay? But if you've paid off debts, or you've gotten a raise, or you've gotten a new job, certainly that should reflect in your budget. So there will be variation, but the best way to do this is it really just comes through practice. Budgeting is not something that you can just set and forget. This is something that will develop and change through time. You're going to start simple by just maintaining your expenses, making sure that things are done. But as we move beyond that approach, this is where you start to go into your financial plan, and that will change through time. Okay, so if you're someone that needs additional steps, you could always do what's called a zero sum budget, which is very tough. We didn't even cover that one today, but that's where every dollar has a destination. At the end, you would have zero left. That's a tough way to go for most families because of kids and other challenges. But as your finances change, as your life changes through time, you will have to make some changes for the better or worse. But hopefully it's more in line with what's the best for you. Always looking to tie your budget towards your larger financial goals, and many of those we've laid out today.
All right, Todd, and then our last question for today: is it best to prioritize building emergency savings fund or aggressively paying down debt?
Yeah, this is a tough one. Okay, so often what we're trying to do is, I would say, it can't be an either or scenario. I would say one that, if you take the example that I've given you here, for $20 a week, okay, we can build somewhere around that $80 amount emergency savings fund. That gets us over $1,000 by the end of the year. So when we're prioritizing, anytime we're looking to prioritize anything that's accumulating debt for us, that always begins to be one of our high priorities, just paying that debt down. But you have to you're going to have to do both of these. It cannot be an either or scenario. I would say start a fund, start putting $20 a week into that fund. If you get paid every 2 weeks, figure out what that dollar amount can be, what you can afford. You want to create a budget, look at your income and expenses. What do you have at the end of the month to work with? That's going to solve a lot of problems right there, just knowing what we have to work with. And then if you're aggressively paying off debts, I would say don't shortcut on the emergency savings fund. Okay, there's always going to be a challenge there. Start something incremental, start to build that fund, transfer over. And then when we think about aggressiveness, we want to think about, what does that really mean? So if you use a financial calculator, debt repayment calculator, that's going to tell us how aggressive we can truly be. But if you need any assistance with that, you've got my contact number right here in front of you. Please give me a call. I'll work with you. I'll work with the credit union. We can look at a plan for you to be aggressive, and I can help align a budget and some numbers that will work in your situation. We could do that over the phone. We could do it coming into the office. Lots of ways to accommodate you with technology now if you want to look at that. But again, everything is going to be tied back to your budget and kind of figuring out what that actually looks like in terms of how aggressive we can truly be. We've got to know what our bottom line is first.
All right, thank you so much, Todd. That does conclude our Q&A session. As a reminder, if you have further questions regarding this webinar or this topic, please reach out to us. And with that, this concludes today's webinar. Thank you all for joining us, and have a great rest of your day.